Thank you for joining me today. I was really excited about this opportunity to come and give this keynote in Prague. And a lot of my speeches have been fireside chats or just discussions. And the organizers in Prague, they're very thoughtful, and I think they're a bit more organized. And they said, you know, you really should come up with slides. And I thought, slides? So this is my first presentation this year with slides. I'm hoping by the time I finish, you'll conclude there is no second best set of slides. And without further ado, I'd like to talk about the future of Bitcoin. So let's start with an observation. There is an endless economic war raging worldwide. It has been raging since the beginning of time. It is going on right now. That war is over the redistribution of economic energy, and we call that wealth. But it is all of the money and the power in the world right now. And so we have a nice map of the wealth of the world here. And the question is, how is that wealth being redistributed every single month and every single year? There are three primary drivers. The first driver is government policy. The most powerful actors in the economic war are governments everywhere in the world. They are moving money around. When I use money here, I mean economic energy or wealth. They're redistributing it. The second big driver in this economic war is technology. It's the advent of the Apples and the Googles, and it's electricity, and it's fire, and it's cars, and it's Teslas, and it's AIs. The third driver in this economic war is work. It's all the hard work, it's the competition, it's the energy. When you get up in the morning, you go and you work as hard as you can. Now, sad to say that the government is an order of magnitude more powerful in that economic driver than the technology. And the technology is an order of magnitude more powerful than your work. And I think you understand this. If you work as hard as you can, but without a machine, or you work as hard as you can without the access to a computer, there's only so far you're going to get. Now, I was thinking about Bitcoin and how Bitcoin plays into all this. And you can see in my chart, Bitcoin's about $400 billion of this $900 trillion worth of global wealth. You see gold is 12 trillion, and equities are 115 trillion. It used to be gold was equal to equity. If you go back 50 years, it used to be gold was about equal to equity. So what happened? Well, there's a lot of technology in equity. You know, we talk about gold being a shiny, dead rock, but think about gold mining and think about what technology has done to gold mining in 50 years. Semiconductors don't make it easier to mine gold. Mobile phones don't make it easier to mine gold, right? What's happened in equity? Well, you've got Tesla, you've got Apple, you've got Google, you've got Amazon, you've got the internet, you've got the telephone. So technology has shifted the balance of power from gold to equity. Government policy shifting the balance of power. Look at bonds. Bonds are driven very heavily by government policy. Real estate driven very heavily by government policy because government policy controls capital and cost of debt, and that drives real estate. And of course, there's money over here. So, most important point is the government is changing this field. Technology is changing this field, and you can work as hard as you want, but you're going to have to take into account government policy and technology if you want to actually survive in this world. The world reserve currency is the dollar. It's collapsing against assets like the S&P index, like real estate, like gold, like art. And this is a sobering thought. If we had sound money, the dollar wouldn't collapse. But you've probably seen this chart. This is the dollar collapsing against consumer goods. Consumer goods, you know, the dollar is 95% weaker. It means consumer goods are 20 times more expensive today than 100 years ago. Now, consumer goods are manufactured items, candy bars, bottles of water, Netflix videos. They're things that are coming off an assembly line and they're getting stamped out with a low variable cost. This is the cheapest, least scarce stuff in this civilization, and yet it's 20 times more expensive. Now, a lot of times, government officials show you this chart and they say, well, this is the impact of inflation. This, in fact, was generated by the Bureau of Labor Statistics. But the sad fact of the matter is, this is as good as it's ever going to get for you. This is a different picture. What if it wasn't easy to stamp out manufactured biscuits or Netflix videos? What if you had to do work to dig the gold out of the ground? Gold is a bit harder. And so the dollar has collapsed 99% against gold in that same 100 years. Not 95%. By the way, gold is not scarce. We keep creating more gold. We get better at it, but at the end of the day, it's a bit more scarce than, Netflix videos, and it's a bit more scarce than drywall. Let's talk about something that's even more scarce. The 500 most valuable companies in the S&P. The US dollar has lost 99.8% of its value against the S&P index over that same 100 years. That is actually a closer measure to the inflation rate. This is the world's strongest currency. This is the currency backed by the country that won every war in the last 100 years. This is as good as it's going to get for you. This is as good as it gets. It will get worse. Now, how do you measure inflation? If I measure inflation against something I can manufacture for free, inflation doesn't look that high. If I measure inflation against a yardstick that is fixed, that's thermodynamically sound, then you see the true measure of inflation. S&P is one example of that. This is Miami Beach. Miami Beach runs 96 blocks. There's that much beach. 100 years ago, there was that much beach. No amount of semiconductor technology or factories make more beach. The dollar has fallen 99.8% against the beach in 100 years. That's how you start to see what's really going on with the world's strongest currency. Now I have some bad news for you. We're not in America. We're in another country. Foreign currencies are collapsing against the dollar. This is the Argentine peso against the dollar. In 20 years, the peso goes from 1 to 500. The peso's lost 99.8% of its value against the dollar at the same time that the dollar's lost 75% of its value against the S&P index. I'll let you do the math. If you run a company in Argentina and you're going to work hard, you're going to have to grow your revenues from 1 million pesos to 500 million pesos over 20 years to stand still. And that's why I say no amount of hard work is going to solve the problem of being on the wrong side of an economic war. There's only one strategy here. You have to get out of that peso. You have to exit. This is the lira. This is before this week. It lost 95% of its value. Now the number is about 97% of its value against the dollar. This is the rupee. It's lost 90% of its value against the dollar. So that 99.8% loss is another 90%. So we're kind of running out of numbers to calculate just how much of your wealth has gone from you to the government. When the government actually collapses the currency 99.9%, what it means is over 100 years, they in essence take all of your wealth and they redistribute it to their cronies, to whoever they want. And that's the rate at which it's going. This is Pakistan, 82% against the dollar. This is the Brazilian real, 65% against the dollar. Conclusion. If you want to preserve your wealth, you have to convert that currency into an asset that's scarce, desirable, portable, durable, and maintainable. Right? There are certain things that are scarce and desirable, but they don't move, like beachfront property. And by the way, maintainable, if you own $1 million of property in Miami, you have to pay $20,000 a year, every year, to maintain it, and it gets assessed up. So you have to have $1 million to cover the taxes on $1 million of property in Miami Beach over about 20 years. You can't maintain it. So you're going to be a smart investor. Here's smart investors, people bragging about making money in the stock market. The S&P index is going up 7 to 8% a year. And so you must be really smart. You invested in companies that are making good decisions. Look at the money supply. The money supply is going up at the same rate as the S&P index. And so what you begin to realize is most investment gains aren't really gains at all. All you're doing is simply tracking the monetary inflation rate if you're lucky. Now let's talk about all the assets. Okay, this is a 30-year or 20-year return on asset classes compiled by J.P. Morgan. On the far right, you see commodities. They're awful. Commodities are silver, gold, natural gas, especially oil, soybeans, lumber, pork bellies. Why are commodities awful? Because humans are really good at creating more of them, and they will drive the price down using technology, ingenuity, and capital. Commodities lose you money. Cash, also pretty awful. Now, you see the inflation rate that the largest bank in the United States marks? They mark it at 2%. That's what the government tells you their inflation rate target is, 2%. That's their consumer inflation rate. That's fake, right? Every single 10 years or every few years, I'll just redefine the market basket of goods, and I'm going to put drywall and manufactured biscuits and Netflix videos and something cheap. You can be sure I take the expensive stuff and I move it out of the consumer basket, and I take cheap stuff and I put it in the consumer basket. And you're moving toward a world where you'll live in a 300 square foot apartment constructed of drywall, sitting on a cheap, rickety plastic chair with a set of goggles on while you imagine yourself in a beautiful universe with a bunch of digital stuff. And you'll get digital healthcare, and you'll get digital entertainment, and you'll have digital friends, and you'll take digital trips to digital vacation destinations in your digital jet. And everything will be good. That's the problem with the CPI. Now, look at the S&P index, right? You feel like you're a genius if you're getting 7.5% against that. But what if I told you the real inflation rate of the US dollar over 100 years is about 7.5 to 8%? That's the actual inflation. Now you see the average investor is getting 2.9% when they're smart. Commodities are less. The S&P is underperforming the inflation rate. Look in the far left. What's your best chance? It's called a REIT, Real Estate Investment Trust. If you have a property company and you buy the scarce, desirable real estate in the middle of London or New York, and if you can generate a yield on it, and if you're really good at it, you might be able to just barely keep your head above water. But you know, none of these look all that compelling, right? I mean, investment consists of either losing your money fast or losing your money slow, or after 100 years of brilliance, assuming that the government doesn't fail and you don't have your assets seized. And I didn't include taxes. As long as you don't die, you don't have any capital gains, and you don't have any inheritance tax, you might barely just keep what you had 100 years ago in this world. Most investors, they just perform poorly because of bad habits. What kind of bad habits? This is a 30-year chart of returns on the S&P index. And this chart tells you that if you missed one day, there's one day every year when 85%, 90% of all of the gains come. One day. And there are 36 hours a year when all investment return takes place. So in 365 days, nothing happens 99.5% of the time. This is why we have the laser eyes. This is why we say hodl. Because, and I have said before, trading Bitcoin is a sign of lesser intellect.